Okay, everybody, welcome to this morning's webinar on intermarket analysis trading forecast for July 23rd, 2014. Now, in this presentation, we're going to be looking at intermarket analysis and how it applies to the Forex market, a review of some of the major pairs and how to apply intermarket analysis when making a trading decision. We're going to be looking at combining intermarket correlations with supply and demand levels, trading the ranges and how to play the breakout, multiple time frame analysis for short-term positions, and of course, proper stop placements. Now, just a little bit about myself. My name is Greg Firman. I've worked in the futures and Forex markets for the last 10 years, and in 2006 founded E-Trade FX. I am Series 3 Commodity Futures and Series 34 Retail Forex licensed and registered with the CFTC and the National Futures Association as a commodity trade advisor. I've worked as an advisor to large hedge funds and individual traders worldwide, providing daily consulting for short, medium, and long-term trading, while also providing very specific risk management models with preservation of capital, the primary focus with, of course, steady growth. I've further worked as a market analyst at TraderPlanet.com since 2008, a prominent free social media website that globally connects traders, where I provide daily commentary to a large number of followers in the Forex, futures, and stock markets. So with all that said, let's get started. What we're looking at for this week, we've had a pretty busy week so far, and we are officially, of course, now in summer trading. Now, when we're looking at intermarket analysis and how it applies to the Forex market, we are going to focus on several pairs here, which is going to be Euro-US, Great Britain-US, US-Japan. These are your key players in the Forex market, and of course, the US dollar itself. Now, the euro has seen weakness, the dollar has seen some strength. So the first thing we want to do is we really want to talk about this. Now, if anybody has been on my previous webinars, you probably know that I'm not a big dollar bull, and it's very difficult to be in that camp these days. Over the last 10, 15 years of trading in the Forex market, I can assure you that the most difficult trade in the Forex market is when you're long the US dollar. And the dollar has some very good rallies, don't get me wrong, but ultimately it succumbs to weakness based on the fundamentals. And that's something we just simply cannot ignore. Okay, so the first thing we want to do is look at where are we currently with the dollar index. Now, the dollar index is 100% correlated to the euro-US pair. If you are trading euro-US, you must be looking at the dollar index. I've talked about this in previous webinars. You can get on a Windsor demo here. I have no affiliation with Windsor brokers whatsoever, but they offer a very unique platform. They offer the US dollar index where we can apply live charts to. That is invaluable. This would probably cost you $200 or $300 a month if you were in the US to get live charts on the dollar index. There are other types of dollar index out there, but they are not a true dollar index. This one is. The DXY is the ticker symbol. So when we look at this, the first thing we want to do is we want to make sure we're staying out on these longer time frames before we're looking at short-term positions, because real money often goes towards these longer time frames for price stability. When we look at this right now, I have these Donchian bands are what I predominantly use to identify the overall trading range in regardless of what time frame I'm using. So right now we can see the upper Donchian band here is 80.92. So obviously with my own direct clients, I'm warning them about any further shorts on Euro-US or longs on US Swiss franc, because these two pairs are 100% correlated to the dollar index. It is indisputable. So if the dollar index goes up, Euro-US goes down. If the dollar index goes down, Euro-US goes up. I'm sorry, but it is that simple. So when we take the best, I'm not sure how many people in the audience here today, when they take a trade and then within a matter of minutes, it goes horribly wrong. And often even with some of the clients that I work with, big and small, a common statement back to me is, it's almost like the broker knew what I was doing. Well, maybe the broker did, maybe they didn't. But I can tell you that usually there was something else involved that caused it to turn violently against you. So the intermarket analysis component here, what you're going to learn today, is things you need to be looking at in Euro-US, Great Britain-US, US-Japan, some of the major players, because they feed the cross pairs. Okay, so any cross pair like Great Britain Swiss franc, Euro-Yen, Pound-Yen, Euro Australia, et cetera, they all feed off the majors. At the end of the day, they all feed off of this. So when we look at things in the dollar index, we are hitting this upper Donchian band. The Donchian band is very similar to a Bollinger Band, but far more effective in my respectful opinion. Now, the Bollinger Band tends to float around, or we could, the cloud is another one. They tend to float and wander around, but they're very, in my respectful opinion, they are very non-committal. This is very committed. We have a very clear horizontal line with a defining resistance point at 80.92. So just like our supply and demand lines, we always want to make sure we understand where current supply and demand is. Now, on the daily time frame, we can see the dollar is having a very good month. We have broken through supply, which is this trend line resistance, and we are pushing up to this level. Our actual target on the dollar index potentially is 81.11. This could have further room to rally, but no matter how we look at it, based on the calculation of the trend line break and the Bollinger Band and the Donchian band, we have considerable resistance forming up here on the dollar index, considerable. And this level has it produced any great trade on the dollar. So we have to be careful of that. Now, as we start to move out towards our weekly, this is the benefit of using the MT4 platform, is that we can check multiple time frames. When we look at the multiple time frame, we've identified in the daily time frame, we have significant resistance between 80.92 and 81.11. When we come into the weekly, we can see we have massive trend line resistance at 80.87. The dollar is sitting. It's sitting there doing absolutely nothing. We've moved up to it the start of the week, but we have basically done very little since. Okay, we've had a little bit of a push down on Euro US, and don't get me wrong, Euro US could very well have considerable more downside, but my optimism on that at this current time remains extremely guarded because I'm applying intermarket analysis here. So when we look at this, we want to take a little bit step further. I want to make sure I stay within my 40 to 45 minute allotted time. So I'm going to move into the currency pairs relatively quickly here. So when we're talking about the Euro-US pair, this is the pair that everybody talks about, that everybody trades. It is the most heavily traded pair in the Forex market. So again, if you're trading Euro-US, then we've got to be looking at that dollar index. And there's a number of other things we need to be looking at here, which I'm going to talk about now. So looking at the Euro-US, when we look at short, medium, and long-term positions, our short-term position, the short-term traders are absolutely selling this. However, we're coming up against some pretty serious issues, in my respectful opinion. We have broken through on the daily trend line and we have moved lower. Our Donchian band is broken, so it does look like we have a little bit more downside. However, we've hit our price target on the daily time frame at 134.50. When we start moving out into the weekly time frame, we can see that using the Donchian band again right here at 134.75 and the 100-day exponential moving average at 134.58, this represents a very significant level of support in the interim after we've had this big move down. Now, again, when we look at this, we have to question whether the bears are really in control at this point. Now, I certainly don't dispute that the euro has its own issues, excuse me, but again, we have to look at the intermarket analysis component of this. So when we bring in the intermarket analysis component for Euro-US, what should we be looking at when we're trading the Euro-US? Should we be looking at Fibonacci? Should we be looking at Elliott wave? Should we be looking at all kinds of different MACD stochastic combinations? Should we apply solely fundamental? The reality is, what I'm going to show you here today is that in 80% of the time, the intermarket analysis component trumps all of that. It makes Fibonacci, Elliott wave, all of these things redundant. So, and people often don't understand why something failed when it did. So when we look at the correlation, we can see here that we have an absolute 100% correlation between the US dollar index and the Euro-US pair. It is not something that is disputable. We can see right here that as they break, as the dollar index goes up, Euro-US goes down. It is that simple. So when we look for, at intermarket analysis components like this, we have to look even further. What is driving some of these things? We know that the dollar index is a driving factor for the euro-US pair, but what else? What I want to point out to everybody here is that there is a significant correlation between the European equity markets and the euro-US. There used to be a very high correlation between the S&P 500 and the euro. Excuse me, but that correlation is almost it's almost there. It's not even there anymore. So it's predominantly we're looking at the European equity markets. We're going to be looking at gold. Is gold correlated? So we can basically assess here that when the DAX 30 moves higher, the euro-US pair moves lower. So basically, just like the S&P 500 and the dollar, when the S&P 500 goes up, the currency of the S&P 500, which is of course the US dollar, tends to go down. So this correlation here, we can see that as the DAX 30 moves higher, that immediately put downward pressure on euro-US. And this is the same thing that's happening right now. So basically, in order for the euro-US to start moving higher, we need to get these European equity markets moving lower. So we need to be looking at that. We have the DAX 30 and the CAC 40. And again, there's several platforms out there that offer CFDs on both the DAX 30 and the CAC 40. We've got Windsor, we've got Vantage FX, we've got a number of different people that offer CFDs where we can do our analysis. So if we're looking at the CAC 40, which is something we absolutely want to be doing, or the DAX 30, whichever one you choose, it's virtually the same. We can see that on a daily time frame that the DAX is still down on the month. Okay, so you can see that I have this monthly opening price here, and it's red with these numbers, and it tells me how many points I am above or below the monthly opening price. Above it, we're kind of bullish. Below it, well, we're kind of bearish. Helps us to determine who's in control of the market here. So on the weekly, we can see on the DAX, we're pushing up against a pretty significant trend line here. When we take it out to the weekly, again, we're kind of holding firm here. So it's a very mixed signal on that. But again, we can make our assessment from a number of different ways. We can see the CAC 40, very bullish on the daily. But on the weekly, not so much. So these are the kind of things we want to look for. But the main thing we want to understand is the correlation. Then we have gold. What about gold? Does gold have a correlation to the euro? In most cases, yes, it does. Is it 100%? No. Is it 80%? Approximately. I would give it 70 to 80%. Absolutely. So when we look at this, we can see that as gold started to push lower, the euro followed it right here. So not only is there one trade in the Forex market or in CFDs, when we're buying euro US, we have to be careful about selling gold, right? We know that there's a pretty strong correlation here, and usually one is a leading indicator for what the other one is going to do. So as you can see, as the euro US starts to plummet, ultimately gold succumbs to that euro weakness right here. And again, these correlations always show themselves, guys. And your Fibonacci, you could say, okay, I'm at 61.8, it's going to bounce, and then all of a sudden it goes right through 61.8 like it's not even there. And this is probably the number one question that comes to me. Why didn't Fibonacci work in this case? It didn't work because, first of all, Fibonacci is something that was not necessarily designed for trading. It was designed in the 16th century. Can we apply it to our trading? We can, and if you like Fibonacci, then you should continue to work with it. Just be mindful that there are conditions in the market that are going to trump it, and it will make Fibonacci render it almost useless. So you just have to be careful of that. So when we're looking at this and we're looking at Euro US, we want to make sure that we are looking very, very closely at what the European equity markets are doing. If the European equity markets are going up, in most cases, the Euro US is going down and vice versa. So if the Euro US is going to bounce right at this level, we would look for the European equities to actually start selling off. That's what we would look for, okay? And it's very important. We see it on the monthly. It's a very mixed signal. But for in this particular case, we have a Donchian band, we have a 100-day moving average, we have a significant amount of support. If we lose this, then and only then will we have a significant downside target. And that is definitely something we want to take into consideration. Now, I want to move in so I get into at least 4 pairs, the 4 major pairs that we can do. So the next pair we're going to advance to is the pound dollar. What should we be looking at with the pound dollar? Now, this pair has been on a quite the little run. And the question is that run over, or is this run just getting started? Are we just pausing? What is the current situation here with this? Now, the one thing I will point out to you that we want to take notice here, and I don't hear a lot of analysts actually talking about it, and the unusually high correlation between the British pound and light sweet crude oil. There is a very, very high correlation here. We can see it virtually all over the place. So if the oil is starting to get a signal to moving to the upside, this would tell me that we would probably get ready to base out pretty soon on the pound dollar, and it would start turning higher. Now, the question is, what else? Do gasoline contracts have a high correlation? They have a very high correlation, but it's not 100%. So when we look at this, okay, I'm getting a message. Really, why? Sorry, Pan, you're going to have to be clear in your question. I'm not sure what you're referring to. So if you could clarify that question, I'll certainly respond to it. Now, again, when we look at this, we can see that the RBOB contracts correlation that oil, yes. So oil, we're looking at the high correlation between these two. I would put this correlation at about 70%. A lot of people don't realize that Great Britain has a lot of oil, they have a big influence on oil in the Middle East, in England, all over the place. And this is a very little well-known fact. So light sweet crude, not Brent. Brent and light sweet crude, very similar pricing. They go up and down pretty much together. Light sweet crude oil is the one that I look at. So with the light sweet crude oil, we can see here that the correlation and the RBOB gasoline contracts, another one that tends to have a heavy influence on the British pound pair. So you can see it right here as the gasoline contracts start to rise, right? So does the pound dollar, very significant, and even this sell-off that turned down here, we can see that the pound ultimately started to follow the gasoline contracts. It took a few days, it lagged behind this correlation, but the correlation is still there. So, and again, we are capable of doing analysis on the, it's light sweet crude oil, it's light sweet crude oil. I'm not sure what you're asking here. So again, when we look at this, we want to look at, again, the, sorry, let me just get back here. When we look at oil contracts, we again have the opportunity with European brokers to do our analysis on light sweet crude oil with several different platforms. We have Windsor, we have Vantage. I think even FXCM offers oil contracts that are based on light sweet crude oil. So when we look at this, again, the oil contracts, in order for the pound dollar to start moving higher, we want to see the oil start moving higher. Now, the other major correlation that the pound dollar looks for from an intermarket analysis standpoint is the FTSE, but it's the exact inverse correlation to what Euro US. For the Euro to move higher, it looks for the European equities to sell off, where pound dollar is the exact opposite. And again, I don't really hear a lot of analysts talking about this. And again, when we look at this correlation here, when the FTSE moves up, the pound has a very positive response to that. And all of these little bumps in the road here, I can change that actually. Sorry, we're going to take that back to anointing here. Okay. Now, when we look at this, what I want to do is I want to just change this back to 3 months so everybody can see this a little clearer. Now, all these little bumps in the road with the FTSE, ultimately it's putting downward pressure on the pound. But as we can see, as the FTSE starts to turn higher, then again, we're looking for the pound to turn around. So we then have to come in and say, okay, is there any area of support here where we can see that the pound potentially will stall out so we can get long again. We have a downside target here of about 168, 169.58. When we come into the weekly time frame here, we can see that this is still very, very bullish. We've broken above that trend line, that former trend line, which now represents support, again confirms that the 169.88 is a pretty significant level where we should start to think about getting long. So Euro US move in the way of gold. Yes, it's the same. Gold right now, gold is under, like the euro, which I'll bring up that gold contract, Chris, so you can see that a little bit better. Here's the daily situation on gold, and this is absolutely critical to watch for two pairs. And I'm going to talk about the next pair in a moment. But this one here on gold contracts right now on the daily, we have pretty big support here, 1301. If we lose 1301 and we have a significant breakthrough here, that is when you're going to see Euro US plummet. If this does not happen, Euro US is going to recover, guys, despite what everybody is saying. And I have no qualms. I don't care if I'm right or wrong. All I'm doing is the analysis and feeding my clients and the hedge funds I work with and saying, look, this is what needs to happen. I don't care about Elliott Wave. I don't care about Fibonacci. I don't care about any of these things because I know that if gold starts plummeting, that is going to trigger dollar strength and it's going to affect the dollar index. That's going to indirectly affect Euro US and down it's going to go. It would take a pretty serious risk-off scenario for that to happen. Is there anything in the pipeline right now that could be considered risk-off? Oh, there sure is. Yep. There's what's going on in Russia, what's going on in Israel. Just a whole bunch of things here, guys, that could trigger, a risk-off scenario. But we'll see how this plays out. Right now, what we're looking at is understanding the key level and not complicating it past that. When we look at it in the weekly, gold has hit its price target and it's in retracement mode. That's where it is. When we come out in the monthly time frame, it is very easy for us to do trades on gold here. We sell the top and we buy the bottom. That's what we do. So right now, the top in gold contracts is 1369. The bottom of that side is 1184. We're looking for a sustained break on either side of this level to continue with longs or continue with shorts. And this is the same thing we want to do on an intraday basis. So when we look at this coming all the way down to the H4 time frame, we can see that we've got pretty significant resistance right now at 1310, and our bottom downside is 1303. That coincides with the 1303 that I'm pointing out to here. So remember, if you really want to get short on Euro US, be patient and make sure that somebody is not tricking you into a short trade here. Remember, 70%, I think by CFTC data right now, people do not make money. So if 70% of the people are going short, you want to be very, very careful of that. That's how I'm going to leave this with Euro US, okay? We know the correlations. We're looking at the European equity markets. We're looking at gold. We're looking at the dollar index. Put that all together, and this is what will make you successful. And again, like I said, I've gone through all the many different wild and wacky and wonderful indicators out there. But the reality is a violent move in another market will affect your target market on an intermarket analysis perspective. So, and again, applying supply and demand levels. And again, a supply and demand level is based on current price. We're drawing our trend lines from right to left, not from left to right. We're taking the most current price and we're applying our trade to that. A trend line from 5 years ago has very little interest to me because it doesn't represent current price, where buyers and sellers are. Right now, we have demand for gold at this price at 1302, which indirectly means we may have demand for euros in the days ahead, unless this level breaks. If we have no demand in gold, we're unlikely to have any demand for euros. Okay, the same thing. Now, when we look at the pound, it does not have an overly high correlation to gold or the dollar index for that matter, but it has a very high correlation to the light sweet crude, the gas contracts, and the FTSE, more than anything, the FTSE. So if the FTSE is starting to turn back higher, then the probability is the pound is probably going to start higher. So later this week, 169.90, if I'm not mistaken. I think we're getting very close to that level today. 170.22, we are. So 169.88, guys, we want to keep a very close eye on that level. Now we're going to come to one of my favorites, which I'm sure is not anybody's favorite on this webinar, US Japan. Okay, so US Japan is probably has one of the strongest intermarket correlations out there right now, and it has not been that difficult to trade. Okay, but market participants, again, we're getting all caught up with overbought and oversold signals, different types of retracement theories on Fibonacci, on Elliott wave. I'm not putting any of these things down. If they work for you, great. I'm simply saying add the intermarket component to whatever you're doing now. Add the intermarket analysis component to what you're doing. When we look at this, virtually indisputable that this dollar-yen pair, like I have never seen before, is absolutely gold. Support on gold is 1305. That's correct, Chris. Yes, we want to keep a very close eye around that 1300 level in general. If we get a big spike, if it starts breaking below 1298, this is a great CFD trade for you guys too, by the way. I trade gold and silver and the equities, but predominantly my main practice is in foreign exchange. So if we get a big sudden push below that trend line at 1300 on gold by, I would say, let's say we get down to about 1286, 1280, sell it immediately. This is what 90% of market participants will not do. They will not sell low and they will not buy high, even though in most cases, when it breaks through that supply line by a certain amount, it is probably one of the easiest trades you'll have because nobody else is doing it, but real money probably is, okay? And at that time, you can fire at will on your Euro-US shorts. What I am simply doing from an analysis standpoint is warning everybody that this may not be what you think it is, okay? So when we're coming to our dollar-yen pair, because my time is getting short here, we're looking at the Nikkei 225. The fact of the matter is that when the Nikkei moves, okay, if the Nikkei moves up, dollar-yen moves up. If the Nikkei moves down, the dollar-yen moves down. This is just simply and virtually an indisputable fact. You can see that this wave formation of these buy and sell signals, they are 100. Nothing's 100, so I'll back that off. 95, 92% correlation is what's happening here. Now, briefly talking about this, this is again, because I've been in the market for so long, I am used to trading the dollar yen in the between 110 and 130 is where I'm used to trading the dollar yen. When I was trading the dollar yen years and years ago, at what seems like a century ago, in the 115 area, the S&P 500 was at about 1600. So the S&P 500 has made a massive move to the upside. The Nikkei has made a significant move to the upside, yet dollar yen doesn't care. Dollar yen is basically, even with these very, very strong equity markets, there is very little, it's pointing again to very little demand for US dollars. Now, what has changed this? What is it? Well, the question I'm sure somebody will ask me is, well, why is it different now than it was 5 years ago, 10 years ago? If you're saying that the equities are having this big rally, why is dollar yen not at 115? Well, the answer to that question is predominantly that China and Japan are circumventing the US dollar in their trade negotiations and in their trade settlement balances. They are settling their respective trade balances in their own home currency. They are not going through the US dollar. Should this not be a massive red flag event for us? But it carried almost zero press time. There was a blip about it on CNBC for about 10 minutes 2 years ago, and nobody's really talked about it since. Well, the fact remains here, guys, that this is a significant event. So the markets, regardless what anybody will tell you, including me, the markets are based on supply and demand. That is the fundamental driving factor of the currency markets or the stock markets or the commodity markets. So this is telling me that we have not virtually, but we have considerably less demand for US dollars across the board. Not just here, but it's really showing up in here, despite these powerful equity markets. So for this particular week, you can probably guess what I'm telling my clients. We are selling into this trend line resistance here around this 101.50. Is that potentially going to break? Yes, it is potential it could break. Excuse me, but it hasn't. And we continue to work the orders on these types of trades until they don't work anymore. And instead of complicating our trading plans and everything else, we want to say, okay, how many times can I do this on a daily basis of selling into this critical level, taking profit and going back and doing the exact same thing the next day? Or I can put dual positions in there, which is what I'll often do, is put one position in, take it out, take it out, take it out, and then I have one longer term position for more of a swing trading aspect. So, but again, swing trading these days, that's a little tough, right? When we come into the weekly time frame, we have a very definable area here to trade, guys. Very definable. 102.45 and 100.80. This simple yellow line is nothing more than a 10-day simple moving average of price. So essentially, as we slip below it, we can see that we're coming up and kissing it at 101.76, but we're not getting over it. There's just very little buyers of US dollars against the Japanese yen. This is just a fact. And we often see heated debates on the direction of the market between analysts, but on forums and things like that. Don't get involved with these heated debates. They're not worth your time. Stick with the facts. The facts are, is there any buyers here? Right now, there is no buyers here, guys. That's it. We don't want to complicate our situation past this. Is it bullish? Yes, it's bullish. You can see across here, there's a sea of green across these numbers. You can see the monthly. We are 15 pips above the monthly opening price. This should be a red flag event here for many people on the webinar also. So during the entire month of July, we're 16 pips above the price we opened at 23 days ago. That's almost, to some degree, that's comical, right? Because you think of everything that's happened in between then and now, that if you bought it or you sold it with no stop loss in there at all, you're up or down 16 pips, right? That's it. For the week, we're up 14 pips. This has a mild bullish tone to it, and it's green across the board, but these are not big numbers. If we were, say, 100 pips above the monthly open, 150 pips above, 200 pips above the monthly open, from a bullish play, you would get my attention. But from this, I'm not getting a bullish sense of this at all. And in fact, I'm getting the potential that this trend line, we could crash off of this level at basically any minute. So if there's any sudden knee-jerk reaction in the Nikkei to the downside, which we now want to come over and have a peek at, that's a problem. And we can see, if you look at the Nikkei rate here, on the weekly time frame, we are up against a massive resistance area with supply. When supply is filled, price goes lower. When there's demand for something, price rises. That's how this works. Okay, we don't want to go past that and complicate things past that. So if we can break through here and push higher, then maybe we've got something on the, but you can see that we have this green line here is again newly formed supply. So we know that looking at our correlations here, that if the Nikkei starts to fall and starts to turn lower, the dollar yen is going with it in a heartbeat. And I mean a heartbeat. It is going to drop almost immediately. When is that going to happen? That could happen in the next 10 hours, guys. The bottom line is, do we want to trade this? Yes, of course we want to trade this. I've had a short on this every day this week, and I'm short again at 101.50. My stop, I'm going to put up above that current range. I would like to have my stop here. When we talk about proper stop placement, this is something we really want to touch base on here, that often the traders will use 20 or 30 pip stops when there's just simply no need to. You're better off to lower your position size and then stack in multiple positions going towards a certain area, towards 102.78 and 100.84. That's the weekly. That's what we're dealing with here. If we start to see our numbers, always know what your monthly opening price. So I can come in here, I can hit my data window. Okay, I can bring this over and I can say, okay, my monthly opening price is 101.31. So at the end of the month, I'm going to be watching this level very closely if we close above it or below it, and how we're going to start our next new month, which I'll talk about in next month's video, and we'll come back and reassess this. But essentially, the dollar yen is range trading, guys. It's just range trading. That's all it's doing. Currencies statistically move 1% of their value per day. That is a fact, okay, which you can check anywhere you like. You can Google it, what have you. The average daily move is between probably 40 and 120 pips, depending on which currency pair you're looking at. But again, we don't want to we don't want to complicate things past this. This chart is pretty clean, okay? It's quite clean, and the only other thing I'm doing is looking at how another market is going to react to this. So again, with gold, I certainly want to touch base on gold here, because this is going to be a leading indicator for not just the euro, but also the Japanese yen. So we have to make an assessment. When gold goes higher, right, we can see that the dollar yen responds by virtually immediately going lower. That means a stronger Japanese yen. So it tells us that the euro is correlated to gold. We know that. But now we can also assess that the Japanese yen has a very high correlation to strengthening gold prices. So the way we're going to play this, again, if you're trading dollar yen, you're trading euro US, US Swiss franc, this correlation cannot be overlooked. That key support level that I've talked about on the gold contracts is critical to our Forex trading, because it is going to be a leading indicator. Right now, we have a very makeshift sell signal on gold. So the yen is a little bit soft, right? That's what it is. I'm going to use that terminology. It's a little soft. It's holding above that 100.84 level. But if there's a sudden spike in gold prices, I think we can all assess, we know what's going to happen with dollar yen. It's going to plummet. Euro US potentially could go higher. There's a number of different plays. Then your commodity currencies are going to come into play. They're going to react to that. So there's a number of different things we want to look at, but predominantly, our main correlation we want to look at, we want to make sure we are looking very closely at the Nikkei 225 if we are trading the US Japan, or if we are trading any Japanese cross pair. Euro Japan, Aussie Japan, CHF Japan, one of my favorites, Great Britain Japan. They're all related to the correlation between the Nikkei 225 and dollar yen. So if dollar yen starts moving lower by, say, 30 pips, that could be as much as 60 pips on pound dollar. So we can, or on pound yen, excuse me. So we can change gears and go over to that pound yen, or maybe go over to Aussie yen or Euro yen, one of the faster moving pairs, and pick up on that. So, again, these are the kind of correlations we really want to look for. So when we break into, some of our other pairs here and opportunity that we have this week. So before we close out the webinar, I've still got a few minutes left, about 5 minutes left here. That's that's kind of funny, actually, because we've got a question here. Can you look at US CAD? And I was just moving to that one. Mindigus, I certainly hope I'm pronouncing your name correct, but thank you for the question. So US CAD, let's look at that, guys. I'm telling my clients, we are short. We are not long this pair this week. We are short. And here is why. We have newly filled supply coming in at this level. We have a candle here that comes up. We have two candles to the left, two candles to the right. This is creating a supply area. And we take the trend line from right and take it back to left, right? And we connect the dots. Our key levels here, UTD line, 107.69, okay? We have 107.69, and you can see the center Donchian band is just as important, guys, as the upper band and the lower band, okay? I want to stress that. And you can see the market is really struggling in this area. So we have a very well-defined range here. 106.43 is our downside target. 107.69 is our supply area. As long as supply is being filled, price will not move higher. That is the basis of supply and demand. So we would sell into this, just like with dollar yen. We would sell into that area. As we come out to our bigger time frames, it starts to get a little messy down here. We're coming off a big retracement point on the weekly time frame, which is the lower Donchian band at 106.19. Now, this big candle you see off of here, and this is something I want to discuss, is about economic data, right? So the Canadian unemployment report was very, very poor this week. 7.1 unemployment, I think. I believe that Canada was supposed to create 20,000 new jobs or 40,000 new jobs. I don't have the numbers in front of me. They ended up losing 60,000 jobs. And this is what turned out to be the scandal. And that sent the US CAD higher. So if that was a good unemployment report, non-farm payroll out of Canada, we'd probably be sitting right now, we'd be sitting probably down around the 105 area. So again, this economic data essentially is very much like noise. It has a short-term effect, but ultimately with the US CAD, you're still buying US dollars. So when you buy US CAD, always keep in the back of the mind, am I holding US dollars? Do I want to hold US dollars, or do I want to hold Canadian dollars? That's the question I'm going to leave you with, is say, we have to make that determination. When we look at things on the monthly time frame, we again 106.15. We have come right off of that trend line, but we are still in this candle. There's that 10-day simple moving average. We are bullish, mildly bullish on the monthly, but do I want to buy up at these current levels? I don't. I quite frankly, I don't. So the question is now, how do we play a breakout scenario? Let's assume that I'm wrong, okay? Because again, we want to look at both sides of the coin here. It's not about being right and it's not about being wrong. It's about doing proper analysis. That's what it's about, and understanding the levels. US CAD, I'm going to sell into this level at 107.69, and I'm going to put a stop about 25 pips, 25 to 30 pips above this key supply line, at which time I will consider having a buy limit order sitting there waiting for it. So I am not going to risk a lot. If you know your key levels, your risk is minimized. So if, let's say, for example, I'm going to sell this thing at 107.60, right? So I have basically 8 pips to the trend line, and I'm putting a stop and then a reversal point of, say, 30 pips above that area. My total risk on the trade is about 35 pips. That's it. Okay, that's it. And then I can, if I'm convinced that this is a true move, it's going to come back down and retrace down to this probably around the 108.80 area, and then it's going to make a bigger push to the upside the next trading day, probably not in that same trading day. So that's how you would play this. But for now, predominantly, people will say that US Canada is in a big uptrend. Okay, that's what they will. Right now, they're saying US CAD's in a major uptrend. That is simply not factual, guys. It is not factual. You want to see a big uptrend? I'll show you a big uptrend. There we are here. I'm just going to close this out so everybody can see this. I'm going to zoom this back a bit. US CAD was at 160.164. Okay, this was in July of 2012. Even if we come back here, when you say that US Canada, it's got to go higher, it can't go any lower, there's very little factual information to support that statement, or that this is in a strong uptrend. So even as recent as here, we were at 130 in 2008. Okay, so in 2008, we had the financial crisis, didn't we? And that indirectly put a risk-off flight to safety bid into the US dollar. That's what it did. So now, as things start to calm down a little bit, the fact of the matter is, this is a major retracement point, and on the monthly time frame, we've been moving consistently lower ever since, right? So shorts all of a sudden aren't really looking so bad, are they, guys? Right? That's what we got to be careful of here. And again, this candle right here, okay, that was this year, January of this year. We had a push up to this trend line, up towards the 113 level, and down it goes again. So it's hard to make a bullish case for this right now. Predominantly, US Canada has certainly been doing a significant amount of range trading. That is certainly what I will say. What I will say. So, but again, there are some very high correlations with the US CAD too. When we look at the US CAD, and then I'm going to have to wrap things up, guys. I'm pushing my limit here now. When we look at the US CAD, keep an eye on the Mexican peso. If the Mexican peso is moving up, in most cases, the CAD is following the Mexican peso. This is really happening a lot. The Aussie dollar, there used to be a very high correlation, what we would call the commodity currencies. Not so much anymore, not so much at all. Light sweet crude oil, There's still a pretty good correlation there, guys. Very good correlation. You can see it. And that's certainly something we want to look at. A lot of times when you get a spike in oil price, that tends to send the Canadian dollar higher. We're looking at Canadian dollar futures contracts, not just the US CAD pair, but I can break it down by futures contracts. But the US CAD will absolutely follow these things. So what I'm going to do here now is I'm just going to take, if you have any questions here that I haven't been responded to during the webinar, but I should wrap things up here because I know we've got other announcers, I believe, coming on. I certainly want to take the time to thank everybody for coming out to the webinar here today, and I hope you have a little bit more insight into the intermarket analysis side of things. I think that it is potentially one of the waves of the future that we are going to be seeing a lot more of these correlations. The markets are very, very choppy, and they are very, very. One market is spooky another market. So predominantly with my presentations now and going forward is I want to bring intermarket analysis into our trading so we can understand what we really need to look for. There is nothing more frustrating. There is absolutely nothing more frustrating when the second you take a trade, it immediately goes against you. And again, we really want to think about that. So in the coming webinars, we're going to continue to pursue our education in the intermarket analysis component and how it's affecting the Forex market. And I certainly look forward to doing further presentations. And once again, I want to thank everybody for coming out today. And I certainly want to thank the good people at FX Street for hosting today. Thank you very much.